and welcome to this Tuesday edition of FreightWaves Now. I'm your host Anthony Smith, and coming up, Mike Baudendistel is going to give us a rail intermodal update. But first, we're going to go to Zach Strickland with a carrier update brought to you by PowerFleet. Stay tuned.
Hey everyone, and welcome to your Tuesday Carrier Update presented by PowerFleet. I'm Zach Strickland, and today we are going to dive right on into those outbound tender volumes, which continue to jump and surge right out of the holiday. We've now finally cleared the Memorial Day trough, the 7-day moving average, of course, occurring over the last week or so. We're now surging out of it at 11,300. One of the strongest recoveries of Memorial Day ever. For those of you that have watched Freight Forecasting with Michael Vincent every Thursday at 4 p.m., he predicted 11,422 coming out of the holiday impact trough here, and we're at 11,304. Pretty darn close. I'll give him credit for it. It's an A-. You don't get an A, but yeah, he got really close there. So yeah, we have shot out of this holiday period. Freight volumes. What you couldn't see is that freight volumes were actually really building out of right after Memorial Day itself. You can see this big weird notch right here. This is Memorial Day right here on the bottom of the blue line this year, and it shot up really fast out of Memorial Day. The other two lines on here, 2018, 2019, 2018 in the green line there, again, very robust, but again, because of the timing of the Memorial Day holiday, they're not lining up perfectly here, so we're still clearing those troughs in the last couple of years. But again, you can tell we had a much softer Memorial Day in those 2 years than the one that we had this year. Again, here in the next day or so, we'll see those comped year over year, and you'll see that this was actually one of the best recoveries we've ever seen out of the Memorial Day holiday period in terms of freight volumes. Looking at the market share, the outbound tender market share through the rest of the country, what is this doing in terms of, which individual markets are outperforming, which ones are slowing down? This is a relative indicator, of course. These markets are all in relation to each other on the outbound tender market share. So Indianapolis, for instance, gaining 8.5% market share in the relation to the other 134 markets in the United States that we have segmented out here. So a pretty strong market. If you can see a pattern here, we have the largest markets right here listed in this tree map up in the top left of the corner, and it flows down to the bottom right corner over there for the smaller markets in the country. Normally, these are the ones that kind of drive that outbound tender volume index for the United States. Ontario, Atlanta, Houston, Dallas, Harrisburg, Pennsylvania, right around Philadelphia. The largest markets in the United States all showing a negative value on the market share. So that's interesting to note. But the pattern that I want to point out is that Joliet, Milwaukee, Indianapolis, Detroit, Minneapolis, all showing in green. These are some of the largest Midwestern markets in the United States. So it is an interesting development to see some of these Midwestern markets that have been very slow to develop this year, actually the last couple of years, save for Minneapolis, really starting to pick back up. Detroit, of course, having that big automotive presence, a 14.7% increase in market share, a very strong number there. So automotive sector is turning back on, ramping back up. Denver, Colorado, we talked about it yesterday, surprising market of the year so far this year. So let's break down a few of these Midwestern markets. Joliet, Illinois. Used to be one of the strongest markets. Way back in 2018, used to be one of the bigger markets in the United States. We've got it broken out into reefer and van volumes. You can see coming out of the holiday, a tremendous spike of volume. It looked reminiscent of the outbound tender volume index for the United States, shooting way up, reefer and dry van volumes out of there. If you look up here at the volatility chart indicator, you've got strong increase in volume. Rejections, not so much. So capacity, not necessarily, it's not driving a lot of tightness in capacity just yet, but volumes, if they do continue on this path, you can definitely consider capacity to be at risk in that situation. Looking at the head haul volatility, a 23.82% increase in head haul volatility over the last week or so. So again, very strong, a lot of tightness could be building up in the Joliet market. Milwaukee, Wisconsin, again, similar pattern here, increasing volumes on both reefer and dry van segments. And just like with Joliet, we had long, mid, and tweener volumes all growing here over the last little bit. And that'll do it for today's Carrier Update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Welcome to your Rail Intermodal update. I'm here with Mike Baudendistel. Mike, what's the latest?
So yesterday, the companies that are publicly traded railroads reported week 22 volumes. They put them on their website, have them up here on the screen, and a lot of negative numbers there. I will say the past 3 weeks have been an improvement. It did sort of bottom out at week 19. This past week was week 22, and you look at the screen, and there's a couple of interesting sort of patterns emerge for me. You see, the Eastern railroads, CSX and Norfolk Southern, carload volumes more severely negative than the Western Railroad, Union Pacific, or the Canadian railroads. Attribute that to steep declines in coal and the industrial economy. The eastern part of the country is a little bit more industrially oriented. You see also intermodal. If you compare these various companies, what they reported for week 22, these declines are less severe than closer to you what we have for all of the second quarter. So the box closer to you is for all of April, all of May, so second quarter, quarter to date. And so you've seen the intermodal start to improve. So we're talking about 10 to 15% declines, a lot better than those 20% declines that we had seen. And then also Canada, outperforming the U.S. railroads, particularly intermodal. They do have some of those faster growing ports in Canada where there's been a lot of investment there as well. This is a chart from Sonar showing the various segments, basically year over year. Fully red screen, coal down 45%, some of these other things that are impacted by energy, chemicals down 15%. So, one of the areas that's less impacted is grain down 5%, but still just taking a tremendous amount of volume off the railroads. So the railroads are running about as fluidly as you can see. I mean, even places that are typically we would have more congestion, like a Chicago, not seeing a lot of congestion. Going back to intermodal, this is from Sonar. We break down domestic intermodal and international intermodal. Think of those as being two very distinct markets. And you've seen that improvement in intermodal that I talked about a minute ago. And when you look at Sonar and break those domestic and intermodal down, really all that improvement has come in the blue line here. This is the domestic intermodal, and you've seen that continue to rise within about 7% of the sort of high this year in March, which is a lot better than most areas of the railroad space.
And one of the first things you mentioned when looking at the most recent results, the Eastern railroads, you spoke about how the industrial sector is struggling right now, and that's been a hamperance on some of them. Do you expect any kind of relief now that we're starting to see latest number from the ISM Institute of Manufacturing numbers came out with new orders starting to slightly increase? Is that an alleviating sign for some of these East Coast production?
I think it could be. I think at least you're starting to see that in certain sectors. I mean, automotive down 70% is a lot better than down 90%. You would expect that to continue to improve. You would expect that some places that were completely shut are going to start to reopen, and there will be some activity. I'm not expecting year-over-year improvement anytime soon, but you should start to see those declines lessen.
And last thing, any other catalyst that might help promote levels other than something from the industrial side?
I mean, I don't know. I mean, there's a lot of economic headwinds right now, a lot of uncertainty. I think companies are just reluctant to make a lot of big investments right at this moment. So I see more negative catalysts on the horizon than positive, actually.
Mike, thank you so much. We appreciate it. And thank you so much for tuning in. That's going to do for this Rail Intermodal update. And that's also going to do for this edition of FreightWaves Now, but the content doesn't stop here. You can check out all of our content on FreightWaves TV app on all your favorite streaming platforms like Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.